Hey everyone, I want to focus on the economic news that came out last week, the second quarter GDP results, and the rate increase by the Fed. But first, I want to put some things in perspective. In the first 6 months of this year, the US economy has added 2.7 million jobs. That's an average of about 450,000 jobs per month. To put that in perspective, between the fourth quarter of 2010 and February of 2020, almost 10 years of steady hiring, we added about 195,000 jobs per month on average. In those 10 years, the best month on record was in February 2018 when 402,000 jobs were added. My point is, the job creation in the first half of 2022 was strong, really strong. In addition, the unemployment rate has been 3.6% for the last 4 months. That's just 10 basis points higher than it was just before the pandemic hit, which was the lowest unemployment rate the US has experienced in more than 50 years. On top of that, underemployment, which tracks people working multiple part-time jobs and people working in jobs for which they're overqualified, stands at 6.7%, the lowest rate since 1969. Here's another metric. Core retail sales, which omits spending on gas and food, are up 5.5% for the first 6 months of the year. Yes, that's getting a lift from the ultra-high inflation, but even on an inflation-adjusted basis, core retail sales are up 3.6% in the first half of the year. On top of that, industrial production in the US is hovering near a record high. The ISM Manufacturing Index reading is 53, and the ISM Non-Manufacturing Index is 55.3. Both are solidly above 50, the index's equilibrium point. That tells us that both the manufacturing sector and the service sector are growing. So if in the first half of the year, job creation has been good, retail consumption has been good, the manufacturing sector has been growing, and the service sector has been growing, then how could the US be in recession? Yes, the GDP number for the second quarter came in negative last week, and that is the second quarter in a row with a negative reading, but that does not mean we are in a recession. Now that takes me to the second big news that dropped last week, the Fed rate increase. The Federal Reserve raised the overnight rate by 75 basis points, in alignment with their telegraph signals of the prior month. That takes the Fed funds rate to a range of 2.25% to 2.5%, which is in alignment with where it was in July of 2019. Of course, the rate increase is in response to inflation. The headline inflation rate is 9.1%, the highest it's been in 40 years. But if you look under the surface, you'll note that a significant portion of the inflation pressure is tied to energy and food, both of which have been pushed up by the war in Ukraine. If you look at core inflation, without the impact of energy and food, the inflation rate is far less severe at 5.9%, and importantly, it has started to level off. Many commodity prices like steel, lumber, and copper have fallen significantly from recent highs, and supply chain problems have started to stabilize. Likewise, it looks like another big inflation driver, the housing market, has started to cool off. Yes, inflation might still be a big problem, but it looks like things might be leveling out. But we're not out of the woods. Inflation could still go up, and a recession could still be in the cards. In addition, the pandemic is still out there, and the global economy is getting weaker. So there are a lot of risks to consider. But for commercial real estate, the metrics are generally holding strong. We're just now getting the second quarter numbers, with both retail and industrial vacancy rates still going down. In addition, the June hotel occupancy rates were back above 70%, nearly where they were in the summer of 2019, and the average daily rate is at an all-time high. Hotels are generally performing well. Apartment vacancy rates, however, bounced up a bit. But I have to point out that apartment vacancy rates in the first quarter were at an all-time low. So the second quarter bump in and of itself isn't really a problem. The office vacancy rate also went up a bit, and that reflects ongoing uncertainty about if or when businesses will return to the office in full. We got some big economic news last week, but for commercial real estate, the outlook remains sound. There is and will be some choppiness, and different parts of the country will experience differing levels of headwinds, but we don't have a broad-based economic decline to contend with. As always, I want to challenge investors to look beyond the numbers that came out last week and consider what's ahead. What commercial real estate demand will look like in 3 years or 5 years as we navigate the current choppiness. We need to keep our eyes on the horizon.